It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I am your host. I'm also one of the certified financial planners on the program. And with me in the KFG studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
One of the more sophisticated strategies with your 401k could become more popular today given the advancing stock market and large number of people retiring. Today, we're venturing into a complex concept called Net Unrealized Appreciation, or NUA rollout. What is it? How does it work? Who's a candidate? And what planning does it require? That and more on today's episode.
Whether this is on your radar or not, this actually might apply to you. So I would, lean in. And then pinky promise, we're going to get to listener questions as well. You guys know we talk a lot and we go deep. And but we're going to get some variety as well. If you have a question for the program, we'd love to hear from you. You can call or text us 574-222-2000. That's 574-222-2000 online. wisemoneyshow.com is where you can find us, leave questions there, engage with us there. And then all over social media, wherever you're at, we are there as well. Search the Wise Money Show, leave questions there also. Okay, if I were to just cherry pick the more advanced strategies that you can do with your 401k, making the list would be the Mega Backdoor Roth IRA. We talk about that quite a bit. In-service withdrawals, that's one. Brokerage link 401k investment options. At the top of the pile, though, I'd probably throw net unrealized appreciation. Mm-hmm. I mean, pretty complicated scenario. Yeah. But the reason why we're launching the show today talking about it is I actually, going on record, saying I think this will apply to more people right now and for the foreseeable future than it has in the past. And yet, like Kevin once asked, if a tax strategy goes unaware, was it even a strategy at all? Or some take on, if a tree falls in the forest and no one's around to hear it, did it make a noise? Sort of thing. Like you very well may not know about this strategy, might do something that is actually a reasonable financial decision, and all of a sudden negate yourself from this even being a strategy at all and lose out on a ton of potential tax benefits.
Right. And it's a one-time opportunity. Yeah. So it's not like, hey, I've got this opportunity all along and I can no. You have one shot. You only have one shot. Do not miss.
Okay, so, go ahead.
Well, I was just going to say, you need to be careful also that your financial advisors, your guides along the way, have their eyes and ears open for it as well. Because how often do financial professionals just get into the rhythm of, hey, you're retiring? All right, let's roll over that 401k to an IRA. Easy peasy, we're done. Yeah. And not pause to say, wait, is there an even better way here related to you personally? So you need to have this on your radar to make sure it's on theirs.
So the question is, do you know, did you know that within your 401k, if you have company stock that you have been investing in or are investing in, did you know you have an opportunity to have a different tax treatment of that company stock when you withdraw it? You would just assume that, no, on my 401k, the tax treatment on the way out is going to be based on the tax treatment on the way in. If I contributed pre-tax, it's going to come out ordinary income. I'm going to have to pay tax on it. If I contributed Roth, then the growth is going to be tax-free. And those are my options. No, if you have company stock in your 401k and you have been investing in it, did you know that you have a choice? There is a strategy where you may not have to pay ordinary income taxes on the growth of that stock. And are you exercising that opportunity, right? You should, working with your CFP. That's the backdrop for what's called Net Unrealized Appreciation, or NUA, and NUA rollout, lots of things like that. Guys, define it. Before we explain how it works, benefits, but also risks or challenges with it, how would you define net unrealized appreciation? And then what areas of someone's financial life does this touch?
So I would separate net unrealized appreciation from the strategy. The strategy is the net unrealized appreciation rollout. So I'll just tell you what net unrealized appreciation is, and Joshua will describe the strategy. So net unrealized appreciation is the company stock that I have that I've bought or the company has granted to me has a certain basis in it. That's what did it cost me to get this stock? So it cost me $50,000.
Yep.
And what is the value of the stock today? Well, I've got $50,000 of my own money or company contributions on my behalf that went into the company stock, and the company stock is valued at 100.
Yeah.
So there's $50,000 of net unrealized appreciation.
Yeah.
And there's something very special that you can do with that money.
Yeah, so think of this as a strategy that works best. Obviously, you have to have company stock. This is only related to company stock inside your 401k. But if you've been employed by the same employer for many years, maybe decades, and it's a company that has been really successful where the stock price during your tenure there, during your career, has just really blossomed, then it is possible that, I mean, we've seen examples where maybe you've invested $50,000 over that period, but what if it's worth $500,000?
Yeah.
You know, where it's mostly the growth in the account. That's where it's so powerful. And I heard an analogy or a metaphor once when you're trying to figure out cost basis and how much is taxable. And there's all kinds of jargon here that CPAs and financial advisors use. But if you are a farmer and you've got a grain bin full of corn, some of the corn is the seed corn, and some of it is the harvested corn that you pulled out of the fields. So it's like the growth on those on the seed and everything. How much is seed corn versus harvested? The more that there's harvested gains or there's harvested corn, the better this strategy works. And you have to recognize that normally when you pull money out of a 401k, all of the corn coming out of the grain bin is going to be taxed the same way.
At ordinary income tax rates, just like you earned it.
That's right. And so whatever tax bracket you're in when you're drawing it out of the account, that's going to determine how big of a bite does Uncle Sam take of your distributions. But this idea of net unrealized appreciation on the company stock that you own inside your 401k, you actually have the ability to take the company stock out of the 401k when you've separated service with the company, when you've retired, whatever. You can take the company stock out and you can pay taxes differently on the seed corn versus the harvested corn. And it can save you massively in taxes if you plan well.
Say you are in the 22% tax bracket doing this net unrealized appreciation rollout strategy. And we'll get into some of the requirements or restrictions here in a second. But in the year you retire, within the year, as long as you meet the other criteria, you would transfer out your company stock, all of it, basis and everything, all of it into a non-IRA account. You would pay ordinary income taxes on your basis, say that $50,000, but then you would pay capital gains taxes on the growth. And that would be, it's significantly less tax. Let's say if you're in the 22% tax bracket, that growth would be at 15% instead of 22%. And again, if you've got a lot of growth, that could be thousands and thousands of dollars in taxes. So that's mechanically how it works. And the primary benefit being, well, you get to take dollars that would otherwise be taxed at ordinary income tax rates, 22%, maybe even 24%, or 12%, say, and instead have the growth be taxed at capital gains rates, which would be at 15%, sometimes 20, or 0%, right? Yeah. So typically, capital gains taxes are going to be lower than your ordinary income taxes. That's how they're set up, and it's done intentionally to try and encourage investment or not discourage investment. So that's the main benefit.
Exactly. It's a way to suddenly get some additional tax diversification right at the beginning of retirement. Otherwise, and if you don't pay attention to this strategy, you don't realize that it's happening, what many people do with their 401k is they just naturally roll it over to an IRA, and they've now closed this strategy off to themselves. Like they've eliminated it. They've missed the chance. Yeah. And it means that all the money in that IRA for the rest of their retirement, when they draw off of it, they may have locked themselves into paying that ordinary income tax, which is the higher of the two different types of tax. Capital gains, at least under current law, provides a significant savings in your tax rate when you can be taxed at those rules instead of ordinary.
Yeah, that's right. So that's the primary benefit. Now, it's not for the faint of heart. I mean, you do give up some things. There are some challenges, and want to communicate really what those limitations are, but also, what you'd be giving up in order to gain this benefit. That plus, who's a good fit for this strategy? How do you plan ahead? We've got that and more here coming up on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern time, every Saturday morning, also on podcast at the same time, and also on a couple local radio stations as well, which is why the content's structured the way that it is. We're at a commercial break right now for radio, try to give you bonus content and all that. But if you're looking for more content designed, again, from a comprehensive financial planning perspective, designed to help you take your next wise step in your financial life, we've got way more than just long-form talk shows right here on this channel. Next wise step videos that air all throughout the work week, as well as shorts as well. A lot of content right here for you. So make sure you hit that subscribe button. Turn on notifications so you're made aware every time we drop new content. Like the content if you'd like it, and leave comments and questions below as well. Is an NUA strategy something that may be a fit for you? Do you have company stock in your 401k? Are you investing in it? Do you have low basis? Is there a lot of growth? Is this a strategy that you're considering, looking at, maybe one that would fit in your financial life? Would love to hear that. Okay, let's get into benefits, but then also like restrictions and drawbacks. Okay, Kevin, are you queued up to maybe get that part of the conversation started?
The benefits?
Well, benefits and then the trade-offs, the drawbacks.
Yeah.
I mean, you gotta pay tax on that ordinary or on your basis.
Yeah.
Immediately.
Yeah.
Right. And if you are, say you've had a lot of appreciation in this company stock, you might say, oh, I'm ready for early retirement. Well, you could also have 10% penalty if you're younger than 55, right? So anyway, but you got to pay the tax on that basis. So you got to have cash flow. And that's, I want to weave into this touches tax planning. Yep. But investment planning, absolutely. Retirement planning, absolutely. Cash flow, right? So a lot. Here we go. Net Unrealized Appreciation, or NUA, rollout strategy. It's a mouthful, sophisticated. I think more people are going to have this strategy at their disposal to save them thousands of dollars of tax. The question is, are you aware of it? And will you leverage it? Will you use it? We're helping with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com. And then all over social media, wherever you're at, we are there as well. Search the Wise Money Show. And so net unrealized appreciation is an advanced strategy, maybe one of the most complicated tax strategies out there related to your 401k. It's not for the faint of heart. There's big benefits where the appreciation on company stock held within your 401k could be taxed or would be taxed at capital gains rates instead of ordinary income rates. That's thousands of dollars of tax, depending on how much growth we're talking about here.
Meaningful.
But there are trade-offs. There are challenges. There are some things that you might not like. Kevin, what are some of those?
Well, one of the challenges is I have to leave the money in my company stock.
Yeah.
So that to me represents a risk. And you say, well, how much money do I want to leave in my company stock? And if I'm working for Salesforce, I'm pretty bummed that I left all that money in my company stock. It got cut in half this year.
Yeah.
So you don't ever know when things are going to happen. The people that had Enron stock in their 401k. Right. I mean, so there are examples where MCI, WorldCom, and go on down the line of where, hey, if I am betting the farm on my company, because I'm already not diversified, because if I work there,
I mean, you've got your income, you've got likely your benefits, and then if you've got a large portion of your retirement savings there as well. And this is why this is a fantastic strategy. And yet the simple rule of diversification actually is at odds against the strategy. So this is where you've got to have your head on a swivel. You've got to be working with a Sherpa who's helping guide you in determining, well, yeah, let's keep this strategy intact, or you know what, based on your situation and the amount of risk that you have, let's diversify some of that company stock.
But it is all strategy, because in the year in which you do this, you're going to pay tax ordinary income tax on the basis amount.
And to me, that I thought that was the first drawback you were going to share. I think that's the big one, because if you've got, let's say you've got $100,000 of basis, and the company stock has been tremendous, and it's grown to $500,000. So you've got $400,000 of net unrealized appreciation. In order to do this strategy, you have to pay tax on that $100,000.
Immediately. When you do the strategy, when you pull the company stock out of the 401k, you're paying tax on the $100,000. All that growth, the $400,000, you can continue to tax defer that. It's not until you sell the stock, start divesting of the company stock, that you would then pay the lesser amount of tax, which is a capital gain tax.
Yeah, and that has to happen within a single calendar year. So I mean, this is laden. This is a minefield. Let's just call it a minefield, and it is very possible to do it wrong. You want to be working with someone who's done this dozens of times and is very comfortable with this strategy. I would say you want to work with someone who's got not only the tax planning expertise in-house, but also the tax preparation expertise in-house. And I would,
and I was going to say the execution of all the mechanics, right? Like setting up the right accounts and making sure that the timing and everything happens. A lot of people, can handle rolling over their 401k to an IRA. That's a fairly straightforward maneuver. But as soon as you start splitting the 401k into different pieces and sending stock over here, and all your mutual funds go into this IRA, and now I got to decide how much tax, where's that money coming from? To do this on your own, I don't know. It feels risky, but to ignore it, maybe shoot yourself in the foot as well.
Well said, actually, because to do it risky, to ignore it is also risky. A few of the other restrictions, all the money needs to be out of your 401k within a year. You can't have taken previous withdrawals. So like your withdrawals all need to happen within this defined period of time. So if you took an in-service withdrawal, if you took other withdrawals, you're going to disqualify yourself from this. And you might think, and you might even be on the phone with someone who tells you, no, you're good. But that will disqualify the entire thing. And instead of just having the basis be taxed at ordinary income, the entire amount would be taxed at ordinary income, because it would be disqualified because you took withdrawals too many times, or you didn't do it all within a 12-month period. The other is the stock needs to come out as stock. You can't say, I'm going to take these dollars. I'm going to sell the stock on my way out, and I'm going to take these dollars and move them over to this non-IRA. No, that would be it. It would disqualify it as well. You've got to transfer the shares, which oftentimes, Josh, you said, your mutual funds go to this account, the stock goes to this account. Typically with the 401k, the mutual funds are sold, and the dollars are transferred to the IRA.
Yeah, I meant the proceeds.
Correct.
Thanks for correcting that.
But I didn't mean to correct, because it's a nuance that is necessary for the stock. The stock, in order to take advantage of NUA, it has to stay intact. You can't sell it.
That's right.
Yeah.
Yeah, and be careful, because we did have a client, Mike and I did have a client that was coming in to meet with us for the first time. And they sold their company stock within the 401k because they said, well, we wanted to make sure we were in a good position to diversify our 401k and pursue whatever strategy you guys would have for us. And
so they wanted you to have a clean slate when you got started working together?
And so they basically they took that off the table as an option.
Yeah.
I think, guys, I want to, who's a good candidate for this? Who's not a good candidate? How do you plan ahead? But while you guys are thinking of that, where we're going, I mean, think about all 6 areas of your financial life. Your financial life has 6 different areas to it. Mine does, Kevin's does, Josh does, Warren Buffett's. Everyone's financial life has 6 different areas. And the big idea with comprehensive financial planning is you need strategy, looking at all 6 areas, okay, infusing them together, and then execution, the implementation of said strategies excellently in each of those areas. When you look at this NUA rollout strategy, you would say, well, that's an investment strategy. Yeah, it is. It's really more so a tax planning strategy, not tax preparation. This is proactive tax planning. Okay, so it hits 2. Well, this is happening at retirement, and it's part of your retirement plan. Okay, so retirement planning. But you've got to pay tax on the basis. So you've got to have cash flow resources to pay that tax. So present financial position. You could even argue protection planning, because is this going to, is there IRMA? Is this going to, because you've got to pay tax on the basis, will you be subject to IRMA depending on when you retire? And then last, but definitely not least, guys, one other huge opportunity here, estate planning. What if you decide to hold this stock and the appreciation of it all the way for the rest of your life, and then you get a step up in cost basis for these dollars from an estate planning standpoint? So
right. So and this is
all 6 areas, guys.
I know, but it's a little tricky because what actually steps up in basis? Not the amount that rolled out of the plan,
right?
But the appreciation on
Since
that amount.
that time.
That's exactly right.
And so all of these things, to know all the gimmies and the gotchas, it is not. This is next level planning.
Yeah.
Yeah, and who keeps track of that? If you were to roll out the company's stock and hold it for 2 more decades.
Oh, everyone does.
Yeah. I hope you've got great record keeping there. But
good candidate. You need to have company stock within your 401k.
Yeah,
that's
what
the prerequisite.
Yeah, exactly. But it needs to be a company stock that has performed well also.
Yeah.
If your company stock is still worth essentially what you bought it for, then there's no appreciation to get this strategy working for you on, right?
If it's a utility or an income play and you're just been getting dividends, there hasn't been appreciation to it. Yeah, that's likely. You might want to check this strategy. There might not be a lot of benefit there.
I feel like from a practical standpoint, this is more likely to be a strategy that someone takes advantage of when their company's stock has surprised them by recent performance. Because I want to go back to something that you said, Mike. Like if you're working with a financial advisor who's helping you manage the risks that you're exposed to in your portfolio, probably a company stock that just keeps on chugging along and is steadily appreciating in value, becoming a bigger and bigger portion of your portfolio, there may be some pruning that's happening throughout the years to just not let yourself get too exposed to one company's performance. And so to me, for you to have a sizable amount of run up in value, of appreciation, it probably happened somewhat suddenly in your industry. And now you're taking advantage of a surprise strategy that's presented itself.
I would also say a good candidate is someone near retirement, but also a good candidate is someone throughout their working career being intentional about, our stock is way down right now. Let me shift my contributions into the company stock and being aware of this potential strategy, even if you're in your 30s or in your 40s, being aware of that. And then having a long tenure at the company, that also is a good candidate as well. All right, we've got more coming up here on the Wise Money Show with Korhorn Financial Group. All right, we'll hit any last words on this, but then we'll stick to our discipline and pivot over to listener questions. All right, the Deal Hunter. Love it. Great question here. I retire in December. My last paycheck is January. Can I make an IRA contribution for that next year? Great question, and we can go deep on that.
I know.
Too.
Okay. So that is okay. So if you're going to put a bow on the NUA, that's what you would deal with this issue right here, because if I'm going to work, excuse me, I need to hit this sneeze button. That's what I hit every morning when my alarm goes off. So here's the thing. If I'm working until September and then I'm getting a 1 year's worth of compensation for the many years that I spent at the company, so I'm basically getting 2 years of compensation in 1 year, and then I'm doing an NUA rollout, it's not a great year tax-wise, if you know what I'm saying. So the question is, if I know this is a potential strategy, can I be planning along the way and say, hey, I want to retire January 3 and let my income for that year be the basis of my company stock. But wait, there's more. Then the next year, what am I going to live on?
Yeah, you sell the company stock.
I'm going to sell exactly
the gains.
$100,000 of company stock and pay 0 federal income tax on that. But what I got to watch for? The state's going to get you.
Yeah, that's good. You want me to say the question and then we put a bow on NUA?
Mike.
So there's the question, what are the conversations you're having with your certified financial planner about this? Or
No, I was going to line up this next question.
Oh, say the listener question. Oh, okay. I thought you were
I don't
teeing
know.
up.
Dude, you're the host. We work for you.
Okay. Got it.
Don't make any.
You're recording that.
do not,
Turn that into a short.
do not wonder.
Here we go. Third segment. If you retire in one calendar year, but you've got some residual pay, last paycheck, maybe some vacation pay, something like that, that spills into the next year, I guess the overarching question, what sort of tax planning strategies exist during that situation? Is it even allowed? And are there opportunities? Yes, there are. We're getting into that listener question right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast. Wherever you listen, just search the Wise Money Show, Apple Podcast, Spotify, all that sort of stuff, and rate the program there as well. We appreciate it. The helpful feedback for us. Are going to turn the table, or maybe just shift the conversation away from net unrealized appreciation, complicated 401k strategy, if you've got company stock available to you as an investment option within your 401k. If you do, I guess I would dare say, if you have company stock as an investment option within your 401k, you need to talk to your CFP about it, period. And you've got to be looking and saying, well, should we utilize this? Should we not? How risky, is this a tax strategy we'd want to consider? What's our approach to this? You want to have that intentional conversation with your CFP, who's, like Kevin and Josh said, who's not only doing the strategy work, looking at all 6 areas of your financial life, but my goodness, it has to be connected to the implementation and specifically the implementation of your taxes.
Yeah.
I mean, if they're just doing the strategy and they're not helping with your tax preparation as well, it's too complicated. It's going to slip through the cracks.
Exactly.
Yeah, we love our brethren that are just fee-only financial advisors and don't mess with the investments at all. But this is one that you could. It's so easy to get it wrong.
Yeah.
That you want someone that does the strategy level and the execution level.
Yeah. All right. So shifting here to listener questions, and this one actually, as we were teeing it up, this connects back to NUA. We'll make a comment on that before we answer it. But this is from the Deal Hunter on YouTube. Love the name. Appreciate it. Here's what he said. My employer pays me on the 20th of the following month. If I retire in December of this year, 2026, I won't get my last pay until January 20th of 2027. So even if I retire in 2026, can I make an IRA contribution in 2027 for the amount of money that I earned in December but received in compensation in January? Fantastic question. We're going to get to it, but Kevin, just take us there with just putting a bow on the NUA strategy and the ability to have some influence over, well, when do you retire and that sort of thing.
Yeah, well, a lot of people right now are using AI as your thinking partner, but I'm telling you, in your financial life, you want a seasoned, certified financial planner as your thinking partner, because what am I thinking about? And if I've got highly appreciated stock, highly appreciated company stock within my 401k, and I want to get capital gains tax treatment on the appreciation, I've got to handle it a certain way. And so, because this ties into, hey, well, what if I was going to retire in September? What if I retire in September, and so I've got 9 months of income, plus I get a severance at the end. Yeah. So I have my income, my severance, and then I do an NUA rollout. So I've got to pay ordinary income tax on the basis that I roll out. So now all of a sudden I'm in
That's
for
a high tax year.
Stacking a lot of income on top of income.
Yeah, the technical term for that is a doozy. So what I might think about is, well, wait a minute. What if I worked just into the new year, and even if I did have a severance, but I have a little severance, maybe a little earned income in the new year, but then I pay the tax on the basis. That might be much, much better. So I might want to align the timing of how I orchestrate all of this strategy. And again, some of these things you have control over, some of these you don't have control over. Yeah. But if you did have control over it and you could make the decisions, your certified financial planner should be telling you this is exactly how to tee it up and make these decisions, so that so in year number one, I'm paying taxes on the basis, and then year number two, for instance, I could sell $100,000 of my company's stock and pay capital gains. And if that's my only source of income, my federal income tax would be 0 on that sale of company stock.
I think the takeaway from all of that should be this realization that when you're getting close to retirement, you need to be having the conversation with your certified financial planner on even things like the logistics or the timing of when you step away. And that's really what Kevin was pulling out. The show so far has been talking about a very complicated net unrealized appreciation strategy. And what if you try to start straddling 2 different calendar years or tax years and all of that? This question from, was it Hunter, the Deal Hunter?
The Deal Hunter.
He's asking, if I have income that spills into a new year, like I've already stopped working, I don't show up at the office anymore, I'm not going to a job site or anything like that, I am done working, but into the new calendar year, I still have some residual income landing on a paycheck somewhere, right? If you do, then it opens up the possibility for you to be able to contribute to something like an IRA or a Roth IRA, as long as you are showing that you've got W-2 income in that new year.
Yeah. So is this allowed? Yeah. This is how it works. All personal or individual taxpayers are on a cash basis, meaning you pay taxes when you receive the cash, not when you earned it. You might be familiar with some accounting principles for businesses. Accrual, no, that's different. That's when it's earned. But in this system, you're an individual taxpayer. You pay tax when you get the cash, and that is paid to you in a paycheck in January. This is totally legal. This is how it works. But then I would challenge, could you do an IRA contribution because you made some income, have some W-2 income in January? Yes, but that's the wrong IRA. I mean, likely.
Should it be a Roth IRA?
Should it be a Roth IRA, right? Because if you're retiring, I don't know the other sources of income that you're going to have and what your tax diversification strategy is, but likely you're going to have more flexibility on your income in retirement, and you might not need a deduction. You might just want to be able to shelter some dollars to never pay tax on them again. And yes, absolutely. Fund that Roth. If you're married, and depending on how much your paycheck is, you can do a spousal Roth contribution as well, right?
You even need to be considering things long before you step away from work and become officially retired. What does that first year look like? And that's what Kevin was alluding to. What are you going to live off of during that first year? Is it some money that you've piled up in a bank account? Is it selling off some company stock, like this sophisticated strategy we were talking about earlier? What's your income going to be? And it's not just the residual paycheck that spilled into the year. When are you turning on Social Security? All of that. That is the type of conversation that you want to have ironed out with your certified financial planner before you walk away from the paycheck.
Yeah, I can tell you don't live in the cold, Deal Hunter, because just retiring in December and then looking forward to January where, I don't have to go to work and I just get to sit at home because the roads are terrible and it's too cold outside. I'm assuming you live in better climate because anyway. But Josh, you're right. When you are retiring, I mean, throughout your career, but certainly when you're about to retire, multi-year tax projection. I mean, you need to be thinking ahead, a couple moves ahead from a tax standpoint to see, well, all right, our income strategy, your lifestyle and all of that. Now, how's that going to look on our taxes? And then therefore, what tax, I mean, I would argue you would need that multi-year tax projection simply to ensure that you've got your tax payments calibrated. I mean, you've got a lot of control over that when you retire as well. You're going to withhold taxes from Social Security. You're going to withhold from your IRA withdrawals. How much do you have to pay estimates? Do you have some other income? You need to figure that out. It's on autopilot for most people during your career. It's very much not in retirement. You don't want to have a big tax surprise or a penalty. So that multi-year tax projection is going to help you with that, but it's also going to help you identify opportunities. And that opportunity could mean, this last year where there's earned income, you can contribute to a tax shelter, and therefore, which is the right one. And then should you do other strategies as well, like Roth conversion,
right?
Delay Social Security until the next year so that that income doesn't land on the return. Or maybe you're turning on Social Security right away, but you've got some other, capital gains that you're going to harvest, that sort of thing. So those decisions all are critical. You want to do that with the foresight of multi-year tax projection.
That's right. And I don't know if everyone fully appreciates the fact that you do have control over what your tax picture is going to look like each year, especially when you get into retirement. You've got multiple places where you can draw income from. You can decide on the timing of when to liquidate certain things. All of that, if you have choice, then have a plan. And that's where your certified financial planner needs to be one of your closest allies as you make this transition into retirement.
That's got to be on a T-shirt or the Wise Money bingo board. Or if you have a choice, have a plan. Yeah, I like it. All right, we've got more questions from fan of the show. We've got that more coming up here on the Wise Money Show with Korhorn Financial Group. What was it?
I don't know.
It was good.
If you have a choice, have a plan. But not to be obtuse, but if you don't have a choice, you better have a stinking plan. I mean, the people that need a plan more are the people that
maybe don't have
a plan so that you will have choices.
There you go.
Whoa.
Okay,
Freedom.
so Steve's question here about can I just pull out can I do a conversion of just the after-tax dollars, not the pre-tax? So we'll hit that one.
Sorry, say that one again.
So basically, if you've got commingled pre-tax and after-tax money in your IRA, and you do a conversion, can you just do the after-tax?
Wouldn't that be nice?
Well, we've got a strategy for them. We can tell.
Cryptocurrencies. Let's hit that one as well.
What's the technical term for that? Is it pro rata? If I convert and I've got
it would be a pro rata conversion.
Yeah. And then IRA aggregation rules.
Right.
Okay. All right. Fourth segment. Probably, I'm assuming just those two questions will be. Here we go. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. Here with me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show, as well as a lot of other content, is on the Wise Money YouTube channel. Go check it out 24/7. You can check it out. Over 2,000 videos, millions of views. Go to the Wise Money YouTube channel, hit the subscribe button, turn on notifications from everywhere. Every time we drop new content, you can leave questions there as well. And you can share content very easily also. We're into listener questions. We have a great one here from Steve. We've talked about this concept a lot. And I feel like we talk about it a lot because this one, it don't make no sense. It doesn't make sense. So here's what Steve asked on the YouTube channel. If you have a blend of converted basis, jargon, I will define that here in a second, some of which would be penalized and others that you wouldn't, can you select which basis you're withdrawing from? Okay, so I think the way I'm reading that question, because converted basis, that sort of thing. Okay, when you are saving money into an IRA, typically you are contributing tax deductible, pre-tax money is going into your IRA, whether that went into your 401k first and you got a deduction for it, and then you rolled it to an IRA, or you made traditional IRA contributions and got a deduction for it. But if you don't meet certain criteria, or your income's too high, then you could still contribute to an IRA. It just, you wouldn't be able to deduct it. So now you have after-tax money and pre-tax money. Mm-hmm. And the question is, I believe Steve is saying, well, when I convert those dollars, can I just grab one portion? Like, can I just grab and convert the after-tax money? Because then when I do that conversion, it wouldn't be taxable because it's after-tax money. So guys, be the bearer of bad news?
Well, what you want to understand is if I had, and again, we're not going to do math on the radio, but if I had $100,000 of pre-tax money, I had an old 401k, I rolled it over to my IRA, so I've got $100,000 there, never paid taxes on any of that, but then I put another $7,500 into it today, but it was after tax. And it's after tax because I make too much money to contribute that to a Roth IRA. Mm-hmm. So, because there's two ways to get money into a Roth. I can contribute, and if I'm below a certain income, married, filing jointly, I think 250-ish, or so I can contribute, or if I make more than that, I can convert. And really anyone can convert. So if I had that $100,000, I put $7,500 on top of it. What I'd like to do is slice it and just take the $7,500 and roll it over into my Roth.
Yeah.
Right, because in the process of converting, if that could be done, that $7,500, you pay tax on your way out of the account, but you don't have to pay tax on that $7,500 because it was already taxed in your scenario. So it would be a tax-free move from the IRA to a Roth in a wonderful, perfect world.
Right.
The issue is that when you've got, in your example, this $7,500 of money that's already been taxed and a whole pile of other dollars that haven't been taxed, when you go to do a Roth conversion, it is assumed that you are drawing off of both pieces.
Right. I want to do a horizontal cut.
Yeah, just
take the 7,500, and the IRS says no, it's a vertical cut.
Yeah, I got to slice it.
So it's proportionate to how much is after tax and how much is pre-tax.
Was it Ed Slott the one who used the analogy of when you have some after-tax money in an IRA and some never been taxed money in the IRA, it's like putting creamer in the coffee. You can't get the creamer back out once it's all commingled and mixed. Yeah. You're taking some out. Now, that's not a perfect analogy because there is a way.
Yes.
There is a way to filter it, but it's a very different strategy than just doing a Roth conversion.
Right.
Which is really the question here.
And what we've seen is some folks that they might not pretend that you didn't have a great 401k or didn't have great investment options in your 401k. So you just make those after-tax contributions and you stack them up. So I do it for 10 years. Now I've got $100,000 of pre-tax because my IRA is not growing at all. So I've got $100,000 of pre-tax and I've got $75,000 of after-tax. What I can do right before I retire is roll that $100,000 into my existing 401k. Because I can always move IRA into 401k. I'm always with an asterisk.
Yeah, if your plan allows, most of them do. Yeah.
So anyway, so I roll that out. So what do I have left? All I have left is that's got to be the coffee. Right? Is that the coffee or the creamer? I don't know. It's all after tax. So then when I move the after tax to the Roth, then that's not a taxable event because it's already had taxes paid on it.
Okay, I'll go back to this. Doesn't make any sense. It doesn't. So you got to work with your CFP because where does all of this shake out in the math? It's on Form 8606. And sometimes, based on those instructions, you might want to do that rolling of an IRA into your 401k in one calendar year and then the conversion in the next calendar year based on how that how you have to fill out that 8606. It's very complicated, actually, that form. I dislike the 8606 form. Talk about things that don't make sense.
Well, tell me about that form that you do like.
Yeah,
so no. Here's the thing. But the other issue is it's aggregated.
Right.
So if you say, well, listen, I've got a traditional IRA.
I'm too smart. I will open up a separate IRA. Yeah.
No, but I've got a traditional IRA here, but I have a SEP IRA over there and a simple IRA over there. So the SEP and the simple don't really, yes, they do count. Right. Like you have to add all of those up and say, all right, that's the amount that is going to be working towards the slicing program.
It's why just doing a Roth conversion, because it makes tax sense, may still hurt yourself because you have to consider the lay of the land and where you've got dollars in various IRAs and everything. So make sure that when you're considering a Roth conversion, you're starting with an assessment on, do I have an easy way to do this conversion and actually get the tax implications or consequences that I'm shooting for. So you need to have not only a tax projection with your certified financial planner, but also they're going to need to know the details on where all the IRA dollars are, how much you've paid taxes on, how much you haven't. It needs to be well coordinated.
Yeah. All right, next question here. We'll wrap up on this one. It's a few months old here from Erica. What are cryptocurrencies and can they be a good investment strategy? Okay, there's a lot here and we don't have enough time to unpack all of it. So cryptocurrencies, I think most people are familiar with them now and they take a different, I wouldn't say you could bundle them all together in one category, but it's a form of digital currency, and I'm using that word loosely. But because there isn't one kind of governing body on currencies or digital currencies, people can create cryptocurrencies out of thin air. So Bitcoin is the most popular, Ethereum, but then you've got a whole bunch that people just make up. And so those coins, if you will, are digital. They trade similarly to the dollar and the yen and other, currencies out there, like tangible currencies, but these are all digital. And you can trade them like a stock, if you will. Now, are they a good investment strategy? Completely depends on the time of year that you're asking. I'm just kidding. It completely depends on what are your investment goals. Cryptocurrencies, I would put all of them into a speculative category. There's a significant chance of appreciation and significant chance of loss, with almost an indistinguishable, like, mathematical way of getting to either of those results. Like, it could just be emotion. So it's very speculative. But then I would also say many of them, but certainly Ethereum and Bitcoin, it's not just a investment. It is also a technological play or a kind of future hedge. Mm-hmm. So is it a good investment? Depends on your goals. They're very speculative. And I would say they're best investments for individuals that are looking for something that also hedges the future that they anticipate. What would you add, guys? I know we're running out of time.
I don't know that I'd add a whole lot. I mean, you could do an entire segment on this topic, I'm sure. But to me, if it's something that you don't fully understand, first, maybe you need to understand it. And I don't think just investing a major chunk of your assets because your neighbor got rich on this over the past several years or whatever is the reason to get started. Like, educate yourself and be limited. Like, you need to make sure that from a risk management standpoint that you're not overexposing yourself to this. Just like we would say, don't buy too much silver, too much gold, traditional assets like that. You don't want to overload yourself.
That's a great point, Josh. Completely agree. All right. That is all the time we have for today. On behalf of Josh Gregory, Kevin Korhorn, all of us at KFG, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.